price is still a function of supply and demand, but it's modified by the flow of money. So let's talk about that money flow. Here again, we're going to follow as two major indices or these baskets of commodities. The CRB index, which is well known, has 19 different commodities in it, 39% energy, 34% agriculture. Crude oil makes up 23% of this basket, so it's more heavily weighted toward the crude oil in the energy sector, whereas the continuous commodity index, or the equally weighted index, is designed to be equally weighted among these 17 different components in this one. 18% energy, 47% agriculture. So we watch how these two move relative to each other. We can get an idea a little bit of how the money is flowing. Let's start first by looking at the CRB index. Now, in order to get this ready in time for compliance, this chart is as of yesterday. So we saw the big sell-off in the stock market yesterday, and I even made this before the end of the day yesterday. This captures much of the sell-off in the commodity sector. And what we saw was the stock market really selling off. Now, as interest rates go higher, and we'd seen an unusually rapid rise in yields on bonds and 10-year treasuries as those markets are being sold off. Typically, when you see a stock market sell-off, it comes with money going toward the typical safe havens, and that would have been like the dollar, government securities, but in this case, or gold, and in this case, gold was stagnant and stale on Wednesday, and these other safe havens really saw a sell-off. The dollar was weaker, the bonds are being sold off, and so the yields are being pushed higher. We saw the yields on 10-year treasuries moving up here a few days ago toward 3.2, it's almost 3.3%. Backed off of that, and overnight we were trading around 3.16%, but then today started going up once again. Now, why does this matter? There's a couple of factors at hand here, and I wish I'd had time to put together some slides today of what was happening to this, but let me walk you through it talking about it. First of all, with these yields, the market is saying higher interest rates are coming. They're afraid that the Fed is going to overreact, which it's had a tendency to do over the decades, and push interest rates up too high too fast. I don't think that's going to be the case with Jerome Powell at the chair. He has somewhat more of a business background than most of those on the Fed board in the past, who tend to be more academics. I think he has a greater understanding of what's happening in this economy. I still don't necessarily approve of everything they do, but I don't expect them to overreact here. And I think they're simply trying to normalize rates. 25 basis point increase per time is really very, very mild compared to history, when we used to see 75 or 100 basis point moves at times. So I think the market can absorb that. I think the economy can absorb this. There's also worries about inflation from the tariff war that we're in, and certainly those sectors most directly involved are seeing higher costs, and we're seeing some of that in the data. But when you look overall at the wholesale level and at the consumer level, we've had data out this week showing we're really not seeing that acceleration of inflation data. So I think this is more fear of the market that had a strong run up since late June, and with not really any setbacks, and now the market's doing a setback. But when that happens, and this is the biggest sell-off we've seen since February, when the reasons for that sell-off were, hey, the same thing, same reasons then, and we recovered from that. It took a while to recover, but when doing so, we also saw a sell-off in the commodities, and that has definitely been the case here. The other factor at play is we had zero or near zero interest rates for so long that the more risk-adverse investor, and those at retirement age or close to retirement age, had to go to the riskier equity markets just to try to keep up with inflation. Now, with returns on government securities going higher, the risk-adverse investor has some options. It doesn't mean the economy is collapsing. The data on the economy is still pretty strong. In fact, some of small business optimism index this week was near record high. Consumer sentiment remains high. A lot of the economic data, we've had some data come out in the last week that showed there are sectors of the economy almost overheating. That's not the issue. The issue is what's going to happen in the future with interest rates and inflation, and that's what got the market spooked. But the other factor is these more risk-adverse investors have alternatives. They start pulling their money out of the stock market. That doesn't mean the stock market can't continue to go higher, but it has less money to do so. And puts more of an onus on those corporate earnings to keep up and keep the money coming. And we're entering that third quarter corporate earnings season now, and so far the numbers are looking good. So as we look here at the far right-hand side, and this chart overall goes back to January of 2016, this far right side, we see this big break that we got this week, and we could extend that even lower from today's action. But we're still in this overall uptrend that we've seen since August. Well, since August right here, we dipped down September, but now we're accelerating the upside until this break. So we're going to have to watch and see how this holds. But overall, I think we're going to survive this okay. But these markets do have some headwinds near term. If we look at the long-term picture, keep in mind that this chart, what you see in this chart, is within the red circle on the right of this weekly chart. This weekly chart goes back all the way to January of 1998, and we can see where we are today versus where we were in the commodity boom of 2008. Those commodity booms only come around every 30 to 35 years. So a little bit of perspective is warranted. We're not looking for that kind of a rally, but just a slow appreciation of commodity values over time. And crude oil has been one of the factors really supporting it. Now crude oil is breaking hard on these same economic fears right now. And we just need to see things stabilize here, and eventually they will, I think. But there is some risk near term, and that's what the market is factoring is an increased risk. We did see the dollar still facing some pressure today, but gold started to pick up buying. And if we're going to have inflation pressures, if there's some risk, gold today did have a breakout on the charts and was a little bit more reflective of what we would start to expect in a fear-driven type of a sell-off in the equities. The continuous commodity index here again did more damage because over the summer, because it's more heavily weighted to the ags, and it's running up against resistance there at that old trend line support level that we broke through over the summer, struggling to be able to sustain a move above that. Now let's look at the crop report in that light. And some of the big stories were this corn and soybean number. The trade was looking for an increase of about a half bushel per acre for both corn and soybeans. It got an increase in soybeans of 0.3 of a bushel, but then USDA lowered harvested acres by 600,000 acres, so production was essentially the same. USDA took the ending stocks number from the September 28 stocks report, which measured stocks as of September 1. It became the old crop ending stocks, new crop beginning stocks as of September 1. That was higher, as you recall from our last webinar. So it put that in there and left most of the rest of the soybean balance sheet unchanged. So we'll get the ending stocks in a little bit. Corn, though, was what really excited the traders. A decrease in yield of 0.6 bushels per acre when the trade was expecting a half bushel increase. So that translated into lower production. Acreage was basically left unchanged. So as we look then at ending stocks for corn, it kept them right around 1.8 billion bushels, a little bit higher than where we were last time because the USDA lowered feed usage by 25 million. And I'm going to talk a little bit more about that as we go forward. Because there are some very interesting things happening in USDA's math. It really looks like USDA is trying to make this balance sheet work to solve to 1.8 billion bushels. a little bit below last month, a little bit above this month. Um, the yield estimate I don't question so much as I do the demand estimates. Now on soybeans, because of the reduced acreage, that offset the increase in yield. Really, the only difference was the higher beginning stocks that were a product of the September 1 stocks report. And those stocks were higher because of lower residual use and also a bigger crop a year ago that USDA has now accounted for. So 885 million bushels, not as bearish as what the trade feared. They were looking for 898 million bushels. That's not that much different, but they feared an even higher number. And here I submitted 935 million bushels for ending stocks. I have since updated my balance sheet since I submitted that estimate, and I'll go through that here in a little bit. So not as bearish. 885 million is still a lot. If we were to get a surprise trade deal here next week with China, we could probably add around 250 million bushels to demand. So that would bring us down to 635 million bushels. That's not as bearish as where we are now, but it's still pretty bearish. But here again, I'll talk more about that as we go. Wheat, 956 million bushels, pretty much what the trade expected. Earlier this week, when corn and soybeans were following the rest of the commodity complex lower and bracing for a potential bearish surprise today, we saw some spreading of wheat against soybeans. Buy wheat, sell soybeans. And so today there was an unwinding of some of those spreads, it looked like, that was pressuring wheat and helping support soybeans. Global ending stocks. The thing I've circled here is global ending stocks of corn, 159.35 million metric tons, very close to what the trade expected, but that's down about 68 million metric tons from where we were 2 years ago. Wheat down instead of up, that the trade had been expecting a little bit of an increase. I was looking for a little more increase when I submitted my trade estimates over a week ago. But since then, we've found out from our Australian team that the Australia crop is probably more like 16.4 million metric tons. USDA went from 20 down to 18, so it looks like more reductions there. And so USDA is starting to tighten up the balance sheet a little bit more, especially among the major exporters. Last month, and I felt like USDA was too rapid in lowering its Russia production estimate, dropping it at to 67 or 68. Last month, they bounced it back up to 71. Today, they went back down to 70. On soybeans, of course, going up about 500,000 metric tons from where the trade was expecting. That's up 2 3/4 from where they were last month. I'm still looking for something a little bit lower than that overall as I work on my world balance sheet. Excuse me. Starting to lose my voice here, so hopefully I'll be able to make it through it. If we look at the state-by-state changes in yield, we see the reductions here. We may see a reduction in North Dakota next month because they've had 4 to 6, even 8 inches of snow there with high winds this week. That was after October 1st, so it wouldn't necessarily be in this report. So I'm sure they lost some corn there. Most of the corn was still standing in the field. We did see a 2 bushel reduction in Iowa, in Illinois, Nebraska down 3. But the eastern Midwest, where we've had a lot of harvest progress already, specifically Indiana, Ohio, Kentucky, we saw some increases there. As we look at where these yield changes came from, we look here at the upper right-hand corner of this chart, the September number versus the October number, and USDA dialing back the ear population slightly, but increasing ear weights as they looked at their objective data and kind of worked in their surveys onto that. So, oh, wait a minute, I did the wrong dot there. I was pointing at the August number. They're all here together. basically this year's record high ear population. So kind of moving around those numbers just a little bit. Okay, as we look at USDA's numbers versus the trade expectations, of course, the August report, USDA was at the high end of the trade expectations. Today's report, they are at the low end of the trade expectations. And generally the trade looking for the increase, and it got a decrease. Not much has changed in Chinese corn supplies. We're still waiting for USDA to have that bearish upward adjustment in the size of China's corn reserve, but then we should see that reserve falling at a fairly fast pace. World stocks, 53-day supply, ratcheting lower each year here last several years, last couple of years in particular. Take out China and the United States, 38-day supply. The rest of the world is at pretty much just-in-time supplies outside of China and the United States. China's supplies are going down rather rapidly. U.S. supplies, you could debate USDA's numbers versus what we think is reality. They're basically stable to increasing a little bit to decreasing a little bit. But even with these big record crops, we're not substantially increasing supplies here in the United States, but we're keeping them adequate for now. Here's my corn balance sheet. A couple things I wanted to point out. First of all, old crop USDA corn here in the left column. The next column is USDA's 2018-19 balance sheet. And here's what I want to point out. Feed usage, USDA had to go down to 5.3 billion bushels for old crop. But they left their new crop at 5.55 billion bushels. They had to lower the old crop because they were assuming too much feed usage with all the dried distillers grains and solubles being fed, etc. But they made no adjustment to feed usage 2018-19. You're going to say, yes, Arlan, they reduced corn feed usage by 25 million, but that was just to offset an increase of 25 million in grain sorghum. So I have new crop corn feeding at 5.415 billion bushels, which that's what, 135 million bushels less than USDA. On exports, I'm about 100 million bushels less than USDA. As I look at the world balance sheet, the supplies that are out there, we are the dominant supplier right now, but other competing supplies are going to come on board. Argentina is now undercutting us in price. Brazil's still priced higher than us. Ukraine, Black Sea corn, I expect to start coming on and being more aggressive here in the weeks and months ahead. So even though we do have a strong export campaign going on right now, I still think USDA was a little too aggressive in raising their export target by 75 million bushels in this report and not reducing their feed usage. So that's why my ending stocks are at 2.189 versus USDA at 1.183. Now, these other alternatives, I just kind of fool with the yields a little bit for the most part. No real change, kind of gives you the boundaries. I right now see 1.8 billion bushels as kind of the minimum that we're going to see unless these exports do pick up much more than what I think and or USDA is right on feed usage. Soybeans, the changes in the yield from last month, much of the Midwest, particularly northern and eastern areas, stayed the same, exception being Ohio going up 2 bushels. Still 60 bushels in Indiana, 66 in Illinois, very good crop. Saw a bushel increase in Missouri, Iowa, and South Dakota, and in Kansas. I thought this is really significant. Look what USDA did in pod counts. Supposedly they were counting pods September 1 and the crop was already starting to turn, leaf turn. We should have been about done with pod set, but they found a lot more pods in October than what they did in September. But in doing so, they reduced their implied pod weight. I thought that was a very significant move from a September to October report on a crop that was ahead of normal maturity. Similar to corn, but not to the same extent. USDA went from the high above the most of the trade to the low end of the trade guess in their production estimate. Now, here's some of the concerns. This is rainfall over the past week, mostly since Friday night. And we see that one pink area with Kansas City in the center of it, calling for 8 to 10 inches of rain. That understates what actually fell. I know some areas had over 13 inches of rain. A lot of rain. Bottom line, persistently wet. If you just narrow it to Corn Belt areas, I think it was 55% who had over 2 inches of rain during that period of time. Soybean belt is a little bit more expansive. We grow soybeans, some areas we don't grow much corn. It was 47% of the soybean belt had over 2 inches of rain. Wet enough to keep those soybeans wet for an extended period of time. And what you worry about then is as it warms up and dries out again, those pods pop open and the soybeans fall on the ground. Well, we haven't really warmed up and dried out to that extent yet, but we're already seeing some reports of that. It's still too soon to know how extensive the losses are. Right now, we're figuring that the worst case scenario might be a loss of looking at what the harvested area was already, et cetera. Maybe about 200 million bushels could potentially be lost this way. We still don't think it's that high. That's still a worst case scenario, but it's still a guessing game. Excuse me. So we're watching this closely. We should know a lot more in the next 1 to 2 weeks. It's going to be a week or 10 days before many of these areas are even able to get back in the field. We also had reports of sprouting, both corn and soybeans, more soybeans than corn. Now, when you look at areas like Iowa, it's too cold for those soybeans to sprout beyond what they're already doing. But as it starts to warm up again, this will be another issue if it's still wet and the humidities are still high. So some real concerns. We have had some quality issues already in the South and in the Mid-Atlantic due to persistent rains earlier in the fall. And so those areas really needed the quality beans out of the Midwest to blend with them. So there's some real concerns here. If we look at soybean production, and I particularly wanted to point out here that over the last 5 years, if you look at this growth in production over the last 5 years, that's 1.33 billion bushel increase in soybean production in the United States alone in the last 5 years. Look at demand. It's been going up too, but not as fast. In fact, and I've got it highlighted there in the bottom, growth in demand over the last 5 years exceeded the growth in production. No, I said that wrong. Growth in demand over the past 5 years is 540 million bushels less than the growth in demand. So that's why we have an 885 million bushel carryout. Yes, if we'd had China business all along, we would have seen lower ending stocks right now. In fact, it'd been so exciting, those ending stocks would probably have a 6 in front of them instead of an 8. Wait a minute, that's awfully a lot of soybeans too. I'm not trying to be derogatory here, but to make a point, it's not just China. It's that we have grown too many soybeans. So the job of the marketplace right now is try to discourage soybean production in this coming year. And that's what it's trying to do, where we're seeing the soybean corn price ratio has dropped so much in recent weeks and in months. And keep on, if you go back to a year ago, the trade war really started in the spring. But if you go back to last fall, in that period of September to December, when we tend to export the most soybeans, that's when we do the bulk of our soybean exports, mostly to China. Exports to China from September to December a year ago were 5 million metric tons less than the previous year. Each million metric tons is 36.74 million bushels. Brazilian shipments to China during the same time period were 6 million metric tons more than the previous year. So China was switching to Brazil even before the trade war started, and that was part of our demand problem we're seeing. is demand in the United States not keeping up with production. African swine fever, I had this slide last month and I kept it in there because I feel like we need to keep emphasizing this. The one big difference here is China is actually lifting some transportation bans. It put those transportation bans in place trying to control African swine fever, because as the hogs are transported, it was spreading the disease throughout the country. Most of the hogs are produced in northeastern areas where the corn and soybeans are produced. But the people of China really value fresh pork. So the slaughter plants are in southern population centers. So the hogs have to be transported 1,500 miles down to the slaughter plants. And that's what was spreading the disease. So they put the transportation bans on. Lo and behold, they couldn't haul the hogs to slaughter then. So pork prices in the urban centers were exploding higher, creating food inflation, upsetting the consumers, which Chinese government couldn't afford to have while in a trade war with the United States that's growing unpopular with the Chinese people, because their economy is starting to suffer because of the tariff war with the United States. So it makes it very suspicious at a time when China is still finding additional cases of African swine fever that they're declaring some regions that first had the disease as free from the disease now, and they can start transporting hogs again. Are they free from the disease? Or is China simply trying to control food prices and avoid food inflation problems, trying to keep the pork flowing? We still expect this to be a major story in 2019 in the protein complex. Most of the hogs, 55% of the world's hogs, produced in China, followed by the United States, way down in second place. If we look at soybean costs to the average Chinese feed buyer, we can see that now U.S. soybeans, with the tariff, with the differences in freight, with currency exchange rate differences, U.S. soybeans are essentially equal in price to Brazilian soybeans. And this is at the Gulf. P&W, you would expect, and certainly we occasionally get a bid there that is cheaper than what the Gulf is, but there's simply no soybeans moving to the Gulf. So therefore, the bids that we get at the P&W Pacific Northwest are totally unreliable for the most part. We don't have consistent bids in order to make this time chart here. We just wanted to show that from the Gulf, they're consistently or competitive now with Brazilian soybeans. P&W, we would expect even more competitive, but Chinese feed buyers are telling us they are afraid to buy Chinese soy or U.S. soybeans because of government official threats on them saying, do not do it. Maybe that'll lighten up after the midterm elections. We don't know. That's speculation. We are seeing soy meal prices hit record high prices over the past week in China as supplies start to tighten up. And basis in Brazil has really been pushing higher as exportable supplies there rally as well. Here again, we see the flattening out of Chinese demand. Much of this is, yes, they're trying to reduce their dependency on soybeans, but also because of the increased supply of DDGs, because of higher ethanol production. U.S. crush activity remains very strong, historically high levels. So as we look at the balance sheet, the first thing to start off with this higher beginning stocks number for the new crop because of the September 28th stocks report. So we translate that into the balance sheet, no other changes. New crop, and you compare USDA to my balance sheet, I'm 30 million bushels lower on crush because I see aggressive pickup in crush in Argentina and Brazil once their new crop supplies are available here in February and March. Exports, I'm higher than USDA, more optimistic that more beans are going to find their way to China in various ways, just like we're seeing happen already with Brazil and Argentina aggressively exporting but needing to import some soybeans in order to crush to meet their needs there. So ending stocks, I'm a little bit higher as a result. Even if you take USDA's number, that's still a lot of soybeans. Excuse me. Now, here's my bear and bull scenario. Here again, I'm using our 54 bushel client yield. USDA is at 53.1. What if we're at 55 bushels? And did I change anything else? I think I left the crush is the same. And exports, I moved down to USDA levels at 2.060 billion bushels. That pushes ending stocks to 1.08 billion bushels of soybeans. That's my bearish scenario, and pull marketing your average cash price down to 760. On the other hand, what if our worst case scenario plays out and we drop the size of the crop by about 200 million bushels? And I see I actually dropped it more than that here, didn't I? So I got more aggressive. Oh, I know what I did. This 4.4, yeah, it's 300 million less than my initial balance sheet, but I dropped it relative to USDA's production estimate of 4.4 billion. That doesn't, oh, I'm sorry. Here, I need to go to this column. Here we go. Here we go. So it's about 230 million bushels less than USDA. What that does is tighten up, and assuming the stronger exports, using my crush number, that drops ending stocks down to 446 million bushels. That's half of where we are now, almost exactly half. That's still 10% stocks to use ratio, but it does justify marketing your average cash of 915, which is certainly 55 cents higher than where USDA is right now. So a trade deal with China that would boost exports, yield losses due to persistently wet weather in the western half, 2/3 of the Midwest. Those factors still can tighten up the balance sheet. It's not what I'm predicting, but it is a risk to the upside for prices. Winter wheat stocks, you can see it class by class. The winter wheat stocks are dropping. Spring wheat stocks of hard red spring and durum are going up. But look at those winter wheat stocks. Even though they're dropping, there's still a 6-month supply for both hard red winter and soft red winter. If we look at the wheat balance sheet, I still think USDA is being way too aggressive on its feed usage estimate. We're down at 80 million bushels. Exports, I'm at 1 billion bushels. USDA is at 1.025 billion. Yes, we're expecting a more aggressive export campaign in the second half of the marketing year, but we are so far behind already. We're going to have to start by digging ourselves out of the hole we're in, let alone try to get up to USDA's current levels. Right now, exports are trailing the seasonal pace needed to hit USDA's target by about 110 million bushels. Weather forecast going forward, well, we're seeing this cold air drop in across the plains in the Midwest right here. That is expected to moderate over the next 15 days. 16 to 30-day outlook puts some cold air over the Great Lakes. Not too much, it's a really concern. We do see the Midwest drying out now over the next 15-day period and looking pretty good for the 16 to 30-day period as well. Southern plains pretty wet, some more tropical moisture coming in, particularly in the 11 to 15-day period. And as a result of all the rain we're seeing, we could see wheat acreage actually decline this year, particularly in the plains, rather than increasing as expected. South America, generally expecting decent growing conditions for both the spring and the summer. Nothing really to imply otherwise. We are seeing a more rapid pickup and movement into El Nino category, warming of the equatorial Pacific waters relative to normal. So what does that mean? Well, I want to call your attention first of all to this table over here on the right. As you can see, it really makes a difference how strong is that El Nino. If it's a strong El Nino, then that really lowers the cases of the analog years that were dry for Argentina and southern Brazil, really raises it for northern Brazil's soybean belt. Excuse me. If it's a moderate El Nino, that's where you get your highest risk of dryness in Argentina, similar to what we saw last year. And it really lowers it for northern Brazil. A weak El Nino, that's kind of middle of the road for everybody. So it matters in how strong that El Nino is. that if you look at the analog years and put them into a composite, it really tends to favor a more of a wet bias Argentina. We see that in both these sides over here. So that's a total of 40%. Still wet Brazil on both of these. A little bit on the dry side for Argentina. Bottom line is we still don't see any immediate threats to South American production. Okay, drum roll. This is the Twitter survey for this month. I know it's unscientific, but it's interesting, and it does help us identify some trends. We just don't know how much we can trust the strength of the trend of the data, but it does give us some pretty strong messages here. Two questions we ask. I'll start with the bottom one. I'm sorry. USDA is providing this tariff aid package, which are direct checks to farmers. $1.65 on half of your production in soybeans, 1 penny per bushel on half of your corn production. Says there may be another payment in December. So what we asked is, how is that going to affect your planning intentions for next year? I personally didn't think it would, because it's a one-time payment essentially, and that's what you told us. It's really not going to affect your planning intentions. You're going to look at what the prices do, watch rotations, but the bigger thing is be responsive to prices when you have to make that planning decision. Which commodity gives you best hope for higher prices? Corn, as you would expect. Certainly we're not going anywhere on wheat to speak of. Corn is the best opportunities. When you have the funds heavily short soybeans, and U.S. soybeans are $2.50 cheaper than Brazil, if we got an overnight announcement of a trade deal with China, don't you think Chinese buyers would be on the phone immediately buying large quantities of U.S. soybeans, and we'd get a rally in the market? But then once that rally is there, it's going to be sold, because there's 885 million bushels of surplus soybeans on top of demand. And so there's a lot of farmers have a lot of soybeans to sell that rally. And so there's more hope longer term in corn. As we're showing, longer term corn fundamentals are good. It's just near term for this year. It looks like we have ample supplies. So looks like the trade war with China is likely here for the long haul. I did a position paper here this week on the trade war with China, and how this is about far more than trying to narrow a trade surplus. This has to do with Taiwan, the South China Sea, China exerting itself militarily. China sees the United States now is trying to step in its way of trying to be economically and militarily superior in the world. And I believe that that's what this is about for Trump. I have for a long time. China didn't think it was. It thought it was just about a trade surplus, but they now get it. They now understand it, and they're not about to give in to President Trump unless they have to. And one of the things to watch is their currency. It's trading at just below 7 yuan per dollar. And if it falls below 7, that's a historically low level. It's in danger of going into free fall and money fleeing the country. Who has that wealth? Well, among other people, primarily leadership in the Communist Party. And President Xi has their support right now. What happens, though, is if they see their wealth start to disappear because of a shrinking value of the yuan, all of a sudden we could get an announcement that President Xi is taken ill. President Xi doesn't want to take ill suddenly and disappear from the public scene. And so I think what we will see, as long as he can control, and he has gained unprecedented powers over the central bank, and he's been taking steps to try to support their currency. As long as he can do that, I think he will hold out. We're talking years rather than months, I'm sorry to say, at least till the next presidential election, unless he starts to sense a loss of support from within the leadership of the Communist Party. Otherwise, USDA appears to be solving its corn balance sheet for a 1.8 billion bushel carryout. After the elections, we may see, and I think we will see, those ending stocks slowly working their way higher. I guess eroding is not the right word. Near-term corn supplies are ample. Long-term fundamentals are supportive. Wheat is still waiting on Black Sea supplies to tighten. That's expected to be December, January time period. Soybean stocks are quite ample, but we're likely seeing the highest numbers we're going to see as production estimates top out. But watch the swine fever, African swine fever development, not only in China, but in Eastern Europe and now in the wild boar population in Western Europe as well. So with that, I'm going to turn it back over to Jake and Sean and see if you have any questions coming through that we can answer. And we always have some good questions come through, and I'm looking forward to what you have for us today.
Thanks, Arlan. We do have a question for you. Will Hurricane Michael affect any of the cotton harvest in Georgia, Alabama, or the Carolinas?
I'm glad you brought that question up. This is more of a grain webinar, so I didn't put any slides in on it. But if you look at the path of Hurricane Michael, now Tropical Storm Michael, and this is an amazing storm. It went from tropical storm status, barely hearing about it, to almost a Category 5, 2 miles per hour lower wind speed. If wind speed had been 2 miles per hour stronger, it would have been a Category 5 when it hit land. And then back to tropical storm status, all that in 3 days. So as it came on land, devastating damage, and it moved right over the southeastern soybean belt, where almost all the cotton, I said soybean, cotton belt, almost all the cotton was open boll. No more than 10% the bolls are still closed. And greater than 75% of it still in the field and unharvested. Most vulnerable state. If you put together all the numbers, we think, and get these numbers from Commodity Weather Group analysis, there could be losses of 5 to 8% of the national crop. I think that's highly significant. That was not factored into today's USDA-WASDE report. The cotton market isn't concerned about that. We really haven't seen much response. I didn't look at cotton today because I was busy with this USDA report on grains. But I did look at the cotton numbers briefly today, but they were before Hurricane Michael. So this will be interesting to watch, because with the water damage, you get bolls pulled out onto the ground, and what isn't tends to have some quality damage. So this is a real issue.
Thanks, Arlan. David has a question. The 60 million metric ton sales from China reserve since April must be turning over reserve stocks with current harvest and not an actual drawdown, correct? If not, what normal supply line is it replacing?
I'm glad you asked that question. I think it was Jamie. Because China has reformed its policy, and it hasn't put corn in this reserve since 2015. And so it's been auctioning off 2013, 14, 15, I think even started with 2012 supplies. And it's down to a little bit of 2014 corn still in it, but mostly 2015. So that's how much demand exceeds their production. That's why I'm more bullish corn long term once this reserve gets used up. Now, USDA numbers pretty well assume that the reserve is gone now. We, based on our sources, believe that the reserve is a little over 90 million metric ton yet. And they have auctioned off better than 80 million metric ton, almost 85 million metric tons since early April. Those sales are starting to wrap up now with new crop supplies being available. So there's no new corn going into the reserve. That's how much our supply has been dropping. And the demand has been growing year on year as they build ethanol plants for their ethanol mandate, 10% ethanol mandate across the country by 2020. So their consumption is going up by that much. So once the reserve is used up, or at least tight enough that the government's no longer comfortable auctioning off any more supplies, then they're going to have to find that corn from somewhere else, which is why I've expected corn to be a big part of any new trade deal with China. Question is now, when will we get that trade deal? I first thought it'd be after the midterm elections, and that's still possible, but I'm now starting to think this is going to be something that goes on for quite some time if President Xi can hold on to his power within the Communist Party through the midst of it. So This again is why I am friendly corn long term. By I say long term, whenever we get a trade deal with China and or beyond a year out. But you know, for a year out, that means we've got to start buying acres for next year. Now, cheap soybean prices can buy a lot of corn acres. So corn prices don't have to rally if soybean prices are so cheap that it discourages soybean production. But I still am friendly corn long term because that's a lot of demand that's going to have to be fed at some point.
Arlen, you mentioned wheat acreage changes. Can you expand on which classes shift? Could spring wheat increase due to space issues for beans in the Dakotas?
It's too soon to say that we'll see an increase in spring wheat. A lot of it comes down to what happens with the Canadian prairies. We've had a lot of wheat that's still in the field in Canadian prairies now with snow on it. So what are the losses they're going to be? And that will impact, therefore, Canadian spring prices. We have seen a push in in U.S. hard red spring wheat basis for the higher protein spring wheat. That Minneapolis, Kansas City spread has widened by more than 20 cents over the last several weeks. So that stronger price, if it holds into those planning decisions after the first of the year, could expand spring wheat production in that area. I think that's more of a factor right now. We were anticipating an increase in hard red winter wheat acreage of 5 to 10%, depending on planting conditions, but now it's so wet and going to be wet for so long. And with all that moisture in the profile, some farmers are saying, why should I put in wheat this late that's going to struggle to get established before dormancy? And I can just wait till the spring and put in a summer row crop and have good moisture in the profile. So we're probably looking right now at a tendency toward reducing intentions for hard red winter and increasing hard red spring, although hard red spring, it's so far until planting that could still fluctuate in either way. Good questions coming in. Keep coming.
We got another one for you, Arlen. Do you expect Congress to complete a farm bill? And when is that timing?
I do expect Congress to complete a farm bill because Pat Roberts, chairman of the Senate Ag Committee, is highly committed to it. I know Senator Roberts not well. I mean, we're not good buddies or anything, but we know each other, and I've heard Senator Roberts talk on this enough to know his commitment, and it is going to get done. There are some significant differences between the House and the Senate, and they are meeting, it seems like on a fairly daily basis, trying to work out on those differences. Timeline, when you look at the number of days left in the calendar of the legislative calendar, we're probably looking at sometime during the lame duck session after the elections to get it approved. That's when more senators and congressmen who are lame duck serving office, in other words, they're going to be leaving office soon. They're less convicted and they just want to pass bills and get them through, and it may be actually easier to get a decision made by then. So probably sometime in that mid-November to mid-December time period before the Christmas recess.
Arlen, that appears to be all the questions for today.
Excellent. Well, thank you very much, everybody. And we'll be back in November for the next USDA crop report webinar. And the key we're watching now in the meantime is, yes, a potential trade war with China. What happens in these equity markets and the risk on, risk off with the money flow into commodities and the ideas about global economic growth and what it'll do for demand for commodities. But also, what's the damage level from all these rains in the Midwest and plains, and does it pull down production estimates? We'll come to talk about it in November at after the crop report. Then we'll see you then.